Hello. This is Lasse Ringius from GGGI. Can you open your screens? Thank you very much. And maybe you can just say a word or two because we have a little bit of issue with the connection. I just want to make sure that it works. I see.
Hi, good morning, everyone.
Good morning. Nice to see you.
Nice to see you too.
Yes, thank you so much. Hello. Hi, Michael.
Morning.
Morning.
Good morning.
Good morning. Okay, thank you very much. And hello, Jakob. Nice to see you too. So very excited to have this event. I'm head of GGGI's investment services. I'm also the country rep in Nepal. I hope there won't be any connectivity issues. We will start this issue with a short video by our president and chair, Ban Ki-moon, after which we will go into the first presentation.
Dear distinguished participants, ladies and gentlemen, it is my pleasure to welcome all of you, the moderators, speakers, panelists, and all participants from Asia and the Pacific to this session of the Global Green Growth Week 2021. Although this year's GGG Week will take place virtually due to the COVID-19 pandemic, my hope is that it will be more green, provide an opportunity for broader participation from more regions and sectors of the world, and ultimately lead to bigger impacts. GGG Week 2021 is a platform for experts and practitioners from all over Asia and the Pacific regions to discuss and share about their experiences, along with innovative ideas and solutions on renewable energy and energy efficiency, finance mechanisms to mobilize green investments, carbon pricing, flood-resilient buildings, blue economy, sustainable landscape, circular economy, and more. I am very pleased to witness the carbon neutrality commitments by 2050 from both governments and private sectors in Asia and the Pacific. Because the current path of growth, dependent on fossil fuels and focused on short-term growth, this is not an option. We need to adopt green growth, a model of growth that is environmentally sustainable and socially inclusive. The Asia-Pacific region has numerous climate-induced obstacles to overcome, including extreme natural phenomena. But it's not just extreme weather events and phenomena. We can read and hear almost on a daily basis now about how climate change fuels conflicts, spurs migration, and poses serious health risks to people everywhere. It is absolutely crucial that we turn carbon neutrality pledges into action and develop sustainable solutions to solve this crisis and build back better. For many, it requires resiliency plans and adaptation projects like those GGGI is supporting for its members in the Pacific. The solutions you discuss in this session can play a major role in the implementation of a green COVID recovery and the climate crisis. As you dive deeper into these topics, I encourage you to actively collaborate in discussions, share best practice and lessons learned, and help us work together to achieve carbon neutrality, recover from the pandemic, and build resilient and sustainable communities. I would like to express my appreciation for your valuable participation in this year's GGG Week, and I wish each and every one of you all the best in strengthening existing partnerships and developing new ones. Thank you.
Yeah, and now we will proceed with their presentations. I really look forward to interesting perspectives, and also hopefully we will have time for discussion, Q&A. So you have around 15-20 minutes, and I hope that will be sufficient to give the basis for a good discussion. And I will also be doing a presentation myself, and looking forward to hear your views and experiences. So the first presentation is delivered by two colleagues from ClimateWorks Australia, Janata Gigankaga, sorry for butchering your name, and Michael Dolan. They are both managers at ClimateWorks in Australia and will cover a wide set of issues from their perspective. So over to you, and looking forward to your presentation. Thank you so much.
Thank you, Lasse. I'm just going to see if I can get the PowerPoint presentation set up quickly before Janata heads us off.
We see it. Thanks very much. Looks good.
Yeah. Thank you. So yeah, very good morning, everyone. So it is our pleasure to share some thoughts in one of the focal events hosted by GGGI right before the COP26. And on behalf of ClimateWorks Australia, we thank you for the given opportunity. So my name is Janata Giwankara, and I'll be accompanied by my colleague Michael Dolan from ClimateWorks Australia. We are sort of a think tank and convener, which working under Monash Sustainable Development Institute to bridge the gap between research and climate actions and accelerate the transitions toward net zero in Australia, Southeast Asia, and the Pacific. So today we will highlight the importance of scaling up catalytic financing inflows from both private and public funds to accelerate low carbon energy transitions in the region. But before we start, let us express our acknowledge of country. So we do acknowledge and pay respect to the traditional owners and elders, past, present, and emerging, of the lands and waters of the people of the Kulin nations on which the ClimateWorks Australia is located, and over 1,000 indigenous people, groups of Indonesia, on which I'm currently calling in from. And we also acknowledge the traditional owners and of the lands from which others may be calling in from. So next, we have 4 main points to be discussed or shared with you today, which begin with the problem statements. In A, the urgency of why Southeast Asia is becoming the hotbed for economic and emission growth, and recognizing the region's efforts to decarbonize its economy and energy system through renewable energy transitions will, of course, have broad ramifications, not only for the region, but also for the global progress in achieving the Paris Agreement target at scale. I will also updating the current status and unpacking the risk and of inactions and opportunities for stronger actions under this first point. My colleague Michael will continue to present the role of public and private financing in supporting ASEAN's clean energy transitions, in which Michael will elaborate how to enhance the current public funding in expediting the climate investment in the second point, and continue to share the primacy of private finance in succeeding the region's shift toward renewables-based energy system. Lastly, Michael will wrap up the presentation by defining what is the key enabling regional and domestic reforms to scale up and the desired and required climate finance in the region. Next. Yeah. With the energy demand increasing by 60% over the last 15 years, and with more than 80% of its energy coming from fossil fuel, the region has become the world's attention in emission reduction. Population growth, rising income levels, and subsequent development gains in the region have driven its emission growth, and especially from the electricity and the heat sectors. Therefore, the region is regarded as the last battleground for climate mitigations. From the graph, we can see that the GHG emission in the region has been increasing from around 1,000 million ton carbon dioxide in 2010 and to nearly 1,500 million ton carbon dioxide in the last 2 years, or in 2019, or has an average of 4% yearly increase. This growth indeed varies between countries, yet the data from IEA shows that Myanmar, Cambodia, Indonesia had the biggest increase with around 27%, 13%, and 9% respectively, while Vietnam and the Philippines had around 8%. So this increase mostly driven by the coal and oil gas usage, coal and oil usage in the most countries, and expected to continue grow to 2050 under the business as usual scenario to reach about 2,400 million tons carbon dioxide if there is without significant efforts to decarbonize its energy system. So for the previous reasons, in the next slide, energy system transformations toward renewable energies is a pivotal in meeting the rising energy demand in the region. In today's share, renewable currently supplying for only 15% of the total ASEAN energy demand, with ups and downs. Total net addition capacities in the last 2 decades presented in the left. Across the 10 AMS, renewable has been growing at a rate of around 7.7% in a compound annual growth rate in the last 5 years, and translating to an average of 6.4 gigawatt of renewables installed, new renewables installed annually. Vietnam and Thailand lead the way with having added a new 16.5 solar PV and 0.9 gigawatt onshore wind, respectively, between 2018 and 2020. But ASEAN is also yet still vast untapped renewable potentials beyond the regional current APEC Power Development Plan. In this case, IEA accelerated case projected that the new solar and PV installations in the region could add up to 26 gigawatt and 12, almost 13 gigawatts respectively in today's capacity by in the next 5 years. Next, so if we break down what is the risk and what is the opportunities, there's more to gain than to lose from a coordinated low carbon energy transitions in the region. We identified 3 sectors, or maybe 3 aspects from the environmental, economic, and social risk, spreading from, for instance, in the environmental risk, escalating the environmental impacts of pronounced ASEAN GHG emission growth due to coal and gas pipelines, including also the increasing water, sanitation, and hygiene issues around the fossil mining areas are the risk in the environmental aspects. While we have also an opportunity to contribute towards the global and also regional GHG emission by translating these systems into more renewable-based energy systems. As for the economic aspects, we see that at least 2 risks if the region has no actions toward decarbonizing their systems. First one, of course, the rising fossil fuel imports, and also higher subsidies pledged by the government to fulfill the energy in the next decade, and also a higher stranded asset potential risk for particularly the coal-fired power plants and also the gas. while by translating or maybe transforming the systems toward green and renewables, we have more green employment potential to tap in, and also trade balance potential, as we have or we utilize the local renewable sources, and also, of course, opportunities for technological and value chain diversification in the region. And last, for the social aspects, public health issues, and also in the just transitions principles, or in the more workforce changes from fossil-based towards renewables become the risk. And as I said earlier, better opportunities in employment, higher health outcomes, and also social benefits is potentially can be gained through the transitions towards renewables. My colleague Michael will continue the following presentation. So Michael, platform is yours.
Thanks, Janata. So I won't spend too long on the intricacies of climate financing in the decade past, except to say, as I'm sure we're all aware, that the $100 billion commitment made at COP15 hasn't been met. So in 2018, the last year in which the OECD has measured climate financing, it reached around 79 billion, which, while falling short, still represented, in fairness, promising progress on the 52.2 billion in 2013 and the 58.6 billion in 2016. But public climate financing in all years, as measured by the OECD, has constituted a really high share of the total. So USD 62.2 billion in 2018 came from public financing, making it very, very important, especially for middle and lower income countries, because this was about 79% of the total. In fact, public climate financing is integral to low carbon and indeed renewable energy transition. And this is especially true, again, for middle income and low income countries, particularly in the form of concessional loans, which carry lower to no interest rates, and they help to attenuate some of the financing barriers faced by those countries. Other financial supports are also super important, especially ones that help to overcome some of the higher costs of capital through these provisions, i.e. through de-risking supports. So emerging academic evidence has laid bare to this trend, which is often faced in climate financing and renewable energy financing, which has been dubbed the climate investment trap faced by such nations. So energy system transitions in developing economies require particularly high investment, but given they're underdeveloped, in some cases, financial markets and domestic risks, investors typically apply a higher risk premium to finance they make available, making the transition more expensive than in countries with a lower perceived risk. Investments are more often thus foregone, creating a climate investment trap. So a climate investment trap occurs when climate-related investments remain low due to a set of self-reinforcing mechanisms with dynamics quite similar to those of the poverty trap. So high risk perceptions produce high premiums, increasing the cost of capital for low carbon investments, thus delaying the energy system transition and the reduction of carbon emissions, while also leading, in some cases, downstream to higher levelized costs of energy. Despite this, unchecked climate change then leads to greater impacts, obviously particularly in Southeast Asia, where 6 of the 20 most climate vulnerable countries in the world are. And it affects production systems, reduces economic output, generates unemployment, political instability, etc. So the provision of affordable public climate financing or other support to attenuate these barriers becomes vital, whether from domestic governments to initiate and incentivize investment, or from international actors such as a development finance institution system and multilateral concessional funds. So obviously, in light of COVID-19, the fiscal capacity of ASEAN member states has been challenged, much like elsewhere. And added to the aforementioned challenges, there is a necessity for public climate financing to be escalated to overcome these high costs of capital and obviously crowd in private financing. As it stands, the problems for LDCs, or least developed countries, are particularly acute. An Oxfam study last year found that actual OECD climate financing had been overestimated and that only approximately 20.5% of climate finance has gone towards LDCs, with the share of non-concessional loans much higher than affordable concessional financing. So it's thus a key in the decade ahead to reverse these dynamics in order to be able to bring LDCs and MICs in ASEAN to level footing with the industrialized world. So obviously, given this, there's much to change in the current climate financing setup for renewable energy transition, but a large focus doesn't just need to be put on the amount of capital, but the affordability of financing for ASEAN member states. So markets won't solve this alone, and the prevalence of non-concessional loans demonstrate that the climate investment trap is real. I want to go through 4 actions that stand out. Actually, I'll just go through 3 actions that stand out as priority to improve the provision of affordable climate financing. The big one, as we know, is the provision of SDRs as concessional loans. So concessional loans, as we just went over, are important to reduce barriers to climate financing, which include higher capital costs and high risk profiles and a mismatch between loan products and the needs of climate-related investment projects. So this is particularly relevant for many ASEAN member states where current budgetary constraints have reduced government's capacities to act as an investor of first resort. And this is, overlaid by the fact that net ODA per capita into the region has remained pretty stagnant over the last 10 years. So, long-term needs are also substantial, not just short-term. Financing gaps across ASEAN are stark. For example, Indonesia's second biennial update report in 2018 estimates a need for $247.2 billion in total to achieve its NDC target by 2030, much of which has to go to renewable energy transition. So there is a clear need for public financing to fill this gap, especially because public sector support is actually very important to these projects getting off the ground in Southeast Asia. One estimate suggests that 55% of renewable energy projects in the region are not viable without public support, while Marsh & McLennan in 2017 calculate that 55 to 65% of infrastructure investments as a whole are not bankable without government or DFI support. So there is potential for the allocation of special drawing rights, which are approved at $650 billion, to be funneled through multilateral concessional funds, or MDBs/DFIs, in order to help with the renewable energy transition. But this is not just as to replace the $100 billion commitment, but to fill out some of the shortfalls of the $100 billion commitment. And doing so will obviously help scale public financing, while also for the countries who are channeling those SDRs, provide a small, below market rate on SDRs, which would be sitting off their balance sheet otherwise. The second is issuance and investment support from DFIs for ASEAN green bonds. So debt financing is going to be really instigative in ASEAN's move towards net zero. Typical debt to equity ratio and overall renewable energy infrastructure project finance is about 70 to 30. And another estimate puts it at 75 to 25. Green bonds are a very important emerging tool to attract private debt financing for low carbon projects. But issuances in ASEAN still remain quite low, especially given some of the emissions growth that we're seeing. We're talking 3% of the global total. So there are a number of reasons for this, but one of them is a lack of track record. Others are institutional settings, and lower sovereign credit ratings also constrain government green bond issuances, which negatively affects perceptions of creditworthiness, which effectively increase the cost of capital. For example, sovereign bonds issued by the Philippines and Thailand have been deemed moderately risky and may at least partially account for why some ASEAN member states are yet to issue green bonds, such as Myanmar, Cambodia, and Laos. So DFIs such as the ADB, AAIB, IFC, and others can play an influential role here. ADB has done so with green bond issuances, raising about $7.6 billion since its green bond program was launched. But there's more work to do, because what DFIs such as the ADB or IFC can do is actually leverage high credit ratings to reduce the effective cost of capital that would otherwise be incurred by some of these markets. And that's very important, because by helping with issuance, like EIB did in Europe to begin with, you help to build market maturity and you help to build track record. So yeah, the IFC has provided support in this regard through the issuances of a Philippine peso denominated green bond and an Indonesian rupiah bond. And also they can play a larger role in building on anchoring and cornerstone investments. The third is strengthened de-risking credit enhancement supports. And this is very important because beyond issuance, it's very important for renewable energy and energy efficient infrastructure projects, which can pose technological risks while also incurring high upfront costs difficult to match with cash flows over the project life cycle. So governments are generally, of course, unable to bear all of the risks associated with such projects, especially during COVID-19 recovery. First loss provisions are one such way to increase attractiveness, as they shield investors from a predefined amount of financial losses, thus enhancing creditworthiness and improving the financial profile of an investment. Guarantor mechanisms are another, whereby a third party provides a financial guarantee, either in the form of a partial credit guarantee or political risk guarantee, to stabilize financing and give assurance to investors that debts can be repaid on some of the bonds. So stronger institutional guarantors can in turn improve the credit rating of bond issuances. So a number of institutions could deploy credit enhancing instruments to a greater effect across ASEAN. The ADB could deepen its commitment, for example, to offer credit enhancement support for green bonds for renewable energy, having done so to good effect in previous instances. For example, in 2015, the ADB provided a guarantee for Renew Power's $68 million green bond in India, leading to a credit rating improvement from BBB to AA+. There is also scope, of course, for increased involvement from the Multilateral Investment Guarantee Agency and the Credit Guarantee and Investment Facility, an ADB mechanism established in partnership with ASEAN. So yeah, I'll move on just because I'm worried that we're running short of time. But broadly speaking, when we're looking at private finance, actors include project developers, commercial, financial, and non-financial institutions, institutional investors who provide a mixture of project debt financing, balance sheet debt financing, project equity, and balance sheet equity. So the headline here really is that private financing is forthcoming to the region at the moment, but there's still work to do within ASEAN to ensure that projects and investments will become more attractive. So this will involve things like the design and implementation of robust procurement frameworks and well-designed contracts with adequate tariffs and price competition that improve the affordability of investment. Regional integration, so regional power integration, APG in ASEAN, is vital to facilitate growth in renewable generation, in particular from wind and solar. But the third is also financial sustainability for utility companies themselves to improve, so policies at a domestic level to improve the investment capacity of utilities as the main investors in grid infrastructure and their role as creditworthy purchasers of power. Now, this dovetails quite a lot with an enabling policy environment, which cannot be overstated as important. So there are, broadly speaking, 5 areas that can be informative for prospective investors, including the market, so whether policies help to create a renewable energy market; uncertainty, so whether policies reduce uncertainty; profitability, whether policies promote an environment for profitability; technology, whether they support technology adoption; and financial resources, so whether they promote funding availability. So I just want to touch on one thing which Vietnam has done to great effect, and that is introducing feed-in tariffs. They've played a major role in increasing renewable energy capacity across Europe as well as in Vietnam. And yeah, these tariffs are basically designed to attract private investment renewable energy sources by providing government guaranteed compensation above the electricity market price. So yeah, first, by setting tariffs, governments can create fixed rather than uncertain revenue flows, thus reducing the risk of investing in renewable energy. And second, by settling the tariffs above the market price, governments can increase the profitability of renewable energy projects. Well, in Vietnam, they were instrumental in huge solar growth in 2019-2020, which surpassed all expectations, with the installation of a whopping 7.3 gigawatts in less than a year. So that was a 25-fold increase in its solar generating capacity in just 1 year. So the monumental uptake of rooftop solar PV in just 6 months was driven by the closing date for a highly attractive feed-in tariff, which was introduced. I think, how am I going for time, Lasse?
I think it's a super interesting presentation, but you're kind of running out of time.
Yeah, I'm running out of time.
Yeah.
Sorry, I'll just touch quickly on, obviously,
Yeah.
market transparency.
Thank you so much, Michael. Yeah.
And yeah, while the number of organizations supporting TCFD, which is very important for ASEAN, has been rapidly growing, so by 85% in 2020 alone, ASEAN has been markedly slower. And this needs to change in order to provide and lock in private financing and provide confidence to the market that renewable, as well as policy signal, an implicit policy signal to the market, that renewables commitments are being made by the government. So anyway, I'll leave it there and open for any questions that people might have.
Thank you so much, Michael and Jonathan. Very, very interesting presentation. I was thinking in terms of Q&A that if there are no urgent questions at this point, we would just wait until we have had all 5 presentations. So I don't see any urgent questions. I hope I'm not overlooking any. So maybe I just at this point go on and make my presentation. And let me, I think it seems you need to unshare, Michael, if I understand the technology correctly. Maybe it is unshared now.
I've unshared.
Can you see my presentation? I hope so.
Yes.
Yeah. So thanks again to the first presenters. We've tried to outline the sequence, so we are moving through the different issues in a kind of a manner where the different presentations speak to each other, and you'll probably see that this presentation really touches on some of the same issues as was just touched upon by our first presenter. So maybe in the interest of time, I'm also going to be a little more brief. I'm going to go through GGGI's experience in mobilizing projects, green climate projects. And let me see if I can get this slide to show the first slide. And that kind of shows our ambition to help match projects with financing. So what we and others are aware of is that there's quite a gap between the project pipelines that are being developed in our member countries and actually getting them to be financed and being picked up by investors. And this issue has unfortunately not gone away, although we see increasing commitments being made also in the run-up to the COP starting next week. Funds are being launched or commitments are being made, but how do we actually match these funds with projects? This is what we focus on very deliberately. And before getting into more of the details, just a quick overview. There are 3 types of investments that we work on. Financial instruments, bankable projects, and what we call national financing vehicles, which are green banks and funds. So we work with project financing, as you see in the middle, and was just mentioned by Michael. So here we want to develop projects that are bankable if possible, and that are in line with the indices and the country plans of our member countries. We also work on financial instruments such as green bonds and maybe climate insurance products. And finally, on national financing vehicles on the right-hand side, which are vehicles that help governments take a more strategic approach to when they bring in investments from MDBs or from the private sector. There are many funds that have been created over the years in emerging markets, but they might not necessarily be coordinated very well, and at some point, and also they might not get refinanced and become kind of dormant. All this work is that leads to investment is informed by our value chain, which you see at the bottom of the slide. So we have some analytics work taking place upstream, where we look at the country economy, and we then go into the sectors. We look at microeconomic impact assessment. From that, we move on into the particular sectors that we are focused on, and from there on, and highlighted in blue, we develop projects that are in line with the growth ambitions of our member countries. All projects that GGGI develop are developed in partnership with our member countries, regardless of whether they are financed by public or private investors. The value chain, you see that again here, and it just highlights that the blue part, which is the one I'm going to talk about today, which is the one our investment officers are focusing on. And so what we're doing here is we are focusing on origination and preparation in the earliest project cycle step. And that's because there's real high barriers for many private sector and public sector players to develop their projects and to put forward the information that investors need in order to do their due diligence on projects. Once projects have been developed to the point where we have feasibility study, done the legal analysis, or at least a first screening of legal issues, maybe looked at power purchase agreement, then investors are able to decide whether or not to go forward with the project, and would often have much more resources than GGGI does to move the projects forward. So at that point, we make our exit from the project. So we take the projects from the early stage, from the idea stage, until the pre-feasibility stage, and at that point, we make our exit from the project. We do stay in touch with the project after that point, but we are not involved as a partner in developing the project from there on. Here are the stages in our project creation approach, and I've already touched on also very briefly: concept, design, and then financing. I should underline, because it's sometimes there's some confusion about this, we are not investing in projects ourselves. We are not providing any of the finance that is being used for CapEx or OpEx for the operation of the project, but we help to design and conceptualize the projects. In doing that, we develop different types of documents, as you can imagine. Some of them are very well known, and meaning that these are the steps that any investor would go through. So we have project ideas, log frames, or theory of change, that those types of steps in the concept at the point of conceptualization. Then we develop info memos that are informed by our findings from pre-feasibility studies, market assessments. We look at the enabling environment, which was just discussed. Very, very important. It goes without saying. Regulations that might be relevant for the sector. We do financial modeling. Look also in some cases on the legal side of the sector or the investment, ESG obviously, and then we reach the point where we have initial proven investor commitment. So we have a signed off by the potential investors that we have identified in terms of an LOI or draft term sheets, MOUs, or such documents that are material evidence of the interest of the investors to move forward with the project. It is important to be cognizant of the issue of risk and risk return. This has also been mentioned by the previous speaker. Risk and returns are issues that I assume are well known, and the interplay between the two for investors. There might be appetite to engage in more risky projects if the return expectations is matching the higher risk. However, or maybe to add, the issue we face with green infrastructure projects is that they are often perceived as being high risk and low return. And this we have tried to just illustrate or visualize in the graph you see on the left-hand side. So the darker dots are showing in various green infrastructure investment projects, and they are sitting at that quadrant where we have at the lower right-hand side, where there won't be much investor interest in these projects unless we do one or two things at the same time. One is that we reduce the risk. We find a way to move these projects from high risk to low risk. And we, if possible, also we increase the return on the project, so it moves from low return to high return. So there are different ways in which this can be accomplished, and when we see and we are working on that when we develop our projects, and the ways this can be done, there will be some examples of that is through certain credit enhancement techniques. It's possible to reduce the risks, and in that way we will see increase in the number of investors who might take an interest in the project and possibly will invest in the project. This is a very simple chart, but I do think that this captures really the problems that we see with a very insufficient or inadequate pipeline of projects in emerging markets, in particular for large infrastructure projects. Here then is an overview of our portfolio since we covering the period from 2015 to 2020. And as you see, there's been a growth from the early year where we mobilized around 131 million to a bit more than 2 billion in 2020. This is the cumulative investment that has been mobilized. We have mobilized these funds on the back of 59 projects, as you can see, and we have tried to indicate what types of sectors that we have been mobilizing these amounts in, or these funds in. The biggest sector is sustainable landscapes, so forestry, reducing emissions for deforestation and degradation, and irrigation, which is a bit more than half of the, so it's a bit more than 1 billion of the 2 billion. Starting in around 2017, you see the yellow slice being growing from year to year, and this is from renewable energy, particular solar energy projects. Probably not surprising, given that some of these technologies are now very price competitive, and countries are increasingly being comfortable making investments and developing the environment that is needed to attract investors. Then there are funds, national financing vehicles, waste sector is a more frequent sector, and then electric buses, electric scooters, and so forth, all under the heading of e-mobility. Here we have a quick slide that shows the average, or actually it's the median size of the projects by region. So we show, as you can see here, we have on the left-hand side, we have quite a number of projects in Africa, and also in Asia, and in maybe a smaller amount in the Pacific, obviously. But what we also want to show is the size of the projects. And in the early years, the project tended to be on the smaller size, which is no surprise, as we are a new organization and we were still in the process of building our internal capacity and hiring staff with the right talents to develop these projects. As you see, the median size of the projects are around 20 million in Latin America, and slightly smaller in Asia and Africa at 7.5, and unsurprisingly Pacific, the projects obviously tend to be smaller in size. These pie charts here and the graphs show then the breakdown in terms of private and public investors, and this is an important one, and maybe to some a surprising one, that we have mobilized quite a lot of commercial capital. This, of course, is key, and the previous speakers very appropriately highlighted the importance of attracting private finance. This goes back to as early as the Copenhagen Agreement in 2009 that talks about the $1 billion a year coming from public and private sector going to mitigation and adaptation projects. We have here highlighted what types of funding is being provided by the private and the public investors. And as one would expect from the private side, we see investments in terms of equity and debt, and also, but not that much. And we also sometimes have results-based financing. From the public sector, it's a more diverse sets of instruments that are being used, or types of financing, with the biggest one being results-based financing, which is financing where grants will be released upon the client reaching pre-agreed in the implementation phase of the project. We also have straight grants of around 30%, less in terms of debt and equity, as one probably would expect, and maybe even surprised that governments do provide debt equity, but they do so sometimes, and then also guarantees. Here we have outlined the types of investors that we have been engaging with. As you see, it's quite a long list, and there are more than 10 types of investors here. We have listed them by volume, if you will, or investment amount that has been mobilized from the various investor types. The biggest one being private companies and businesses, as you see at the top. I think without going into the numbers, this actually slide goes back to something I mentioned earlier, which is that it's difficult to match projects with investors. For many companies in emerging markets, navigating the climate financing landscape is really very challenging, and there are numerous organizations with each their requirements and processes. Needless to say, the forms and templates and proposals need to be prepared, and this is often a very tall order. Regardless of that, you see here the types of investors and then what types of instrument that they have been providing. We have just added a couple of examples of the types of projects we have been working on. There are more information obviously available, publicly available. Here is a project from India, a fairly recent one, where we helped provide solar PV systems along a new highway in the state of Maharashtra in India, a 700-kilometer long highway. Project size is 150 million. 250 million megawatt of solar PV will be installed along the highway. There are many, or there are several other such projects being prepared now in India. So we are very excited and very fortunate to be able to work with the government of Maharashtra in developing this project here. So I'm just going to go to the next slide. The next slide is then a different type of instrument. This is an example of NFV, a national financing vehicle, one we've been working on for several years in Mongolia. It was finally capitalized by the Green Climate Fund last year. The size of the fund is 50 million. And you see it's a little bit too detailed maybe to get one's head around, but you see the structure or the design of the fund and the various investors and participants on the slide. This is a case where we have that the Mongolian government is providing equity as into this particular capital structure. We also have all the Mongolian private banks are participating in this facility. Public sector is also providing debt, and then, as I mentioned, we got funding from the Green Climate Fund. So this is an example of one of these funds that we have been working on and will continue to work on in the future. Here's another example from Asia. This is a waste project from Vietnam, where we worked with DFIs to get the acceptable capital structure developed. You see the breakdowns, the various numbers of debt and equity and so forth here. So all this is just a quick run through our experience from 2015 to 2020. We have documented this experience in a recent report that I would invite you to study if you are interested, and would be happy to provide any follow-up information as needed. So I will at this point pause, and I think we should move on. I don't see any urgent questions at this point, so I think we should move on to Dr. Hannah Kang and Min-Chul Kim, who's gonna from the Green Technology Center in Korea, and they are going to be presenting on the status of green recovery spending in developing countries with a focus on the green climate technology. So over to you. Hello?
Hello.
Yeah,
Yes.
hi. Yeah,
Hi,
maybe you were on mute. Please go ahead.
Since you are sharing your screen, so I'm not able to do it. So would you like to turn off your?
Yes, it's off now. Sorry about that.
It's okay, fine, thanks. So hope now it's on.
Yes, I see your screen. Thank you very much.
Okay, thank you very much for introduction. And this is Hannah Kang from Green Technology Center in South Korea. So the previous presenters have shared ideas about how to mobilize and accelerate climate finance for transitions. I depict the current status of green stimulus investment during COVID-19 crisis. Several reports have been already released showing the status of green recovery investment globally. So this presentation will zoom in green recovery spending in developing countries with the focus on green climate technology. The presentation is divided into 4 parts. Firstly, I will briefly describe how the world has been doing in achieving net zero goals. Then the second and third part will introduce the concept and framework of green recovery and green climate technology, GCT. Then the rest will present the result of data analysis on the status of green recovery and GCT. In 2015, Paris Agreement was adopted. by 1996 parties at COP21. Its goal is to limit global warming to well below 2, preferably to 1.5 degrees Celsius, compared to pre-industrial levels. Last month, UN Climate Change has published NDC synthesis report on the information from the latest 164 NDCs of all 191 parties to the agreement. The updated NDCs are expected to reduce more emissions by 2050, comparing to the ones submitted in 2016. In addition, currently 13 countries have a legally binding net zero emissions target. However, many studies have concluded that the world is not on track to achieve the Paris Agreement goals, as also mentioned by Executive Secretary of UN Climate Change. If you see the figure on the left, the emissions gap report shows that under unconditional scenario, 15 gigaton CO2 emissions should be reduced more for 2 degrees Celsius limit and 32 for 1.5 limit. And here, what has worsened the situation is that global society now has the burden to recover from unprecedented pandemic crisis, but in a green way. This is the concept of green recovery, spending with a likely positive environmental impact. Here on the left, the graph here shows that after the financial crisis in the past, CO2 emissions level increased after temporary decrease. Having said that, what worries us now is that during COVID-19 pandemic till now, only 1/6 of green stimulus spending has been invested, comparing to the ones responding to the 2008 financial crisis. Here on the right, in fact, many studies assure that different green investments have created diverse economic benefits, including job creations, in addition to emissions reduction. In pursuing green transitions, a technology has a significant role, which is today's topic for my presentation. There can be transitions towards sustainability when innovative green technology may replace traditional fossil fuel-based technologies. In this regard, the South Korean government, in collaboration with the Green Technology Center, has developed climate technology taxonomy with 45 technologies in 14 sections in mitigation and adaptation that are primarily aimed at technology transfer to developing countries. It includes new and renewable energy generation, transmission, storage, and also greenhouse gas sequestration for mitigation. And for adaptation, technologies are allocated to different divisions such as agriculture, water, and ocean. In order to understand the current status of green recovery, especially in developing countries, the research used data named Global Recovery Observatory, which shows more than 5,400 stimulus fiscal spending policies of more than 50 countries around the world. This is the scope of the analysis, that the data has the stimulus package, which is composed of rescue spending and recovery spending. But we're going to focus on the recovery spending. Scope recovery spending. And within recovery spending, this is non-green spending and also green recovery spending, so that we will focus on this part. And within this, there is non-infrastructure and technology, which is green climate technology. So we're going to dive in this section of this data. It has focused on developing economies, which are classified by income level. and also OECD DAC list of ODA recipients into 6 regions. As a result, 18 developing countries were selected that have green spending according to these GRO data, responding to COVID-19 pandemic since 2020 till May 2021. By income level, 10 countries are from upper and middle income countries, and by region, 7 countries out of 18 come from Latin America. So this is the result of green recovery spending from the data. In total, $56,600 million in total were spent for green recovery of 18 developing countries. And out of it, only 11.6% of recovery spending is green, and only 0.26% of GDP is for green recovery spending. This is the result of the data analysis. This axis is the recovery spending percent GDP, and this is green recovery spending percent of total recovery spending. So these two are the exceptions, that it has higher recovery spending while 0% of green recovery spending, while Bangladesh has a lower recovery spending, but has a higher percentage of green recovery spending. And if you see here, they are the 100% green recovery spending out of their recovery spending. So it can be divided into 2 sections. This group has lower recovery spending as well as green recovery spending, but they have lower recovery spending, but with higher percentage of green recovery spending. So they may have higher ambition and government will to invest more on green stimulus during COVID-19. So if you divide them into income level, these parts are mostly from upper middle income countries, which may be also interpreted the government will for green stimulus in the recovery process of COVID-19. So from this graph, we can analyze the fact that most of 18 developing countries, they are still not on the track towards green recovery. Lower percent of recovery spending plus lower percentage of green recovery spending. So this is the place where more countries should pursue for green recovery. The second analysis about the portfolio of green climate technology out of green spending, green recovery spending. Out of it, most of them, 99.6% of green recovery spending is about green climate technology. And if you divide them into mitigation and adaptation, they are balanced. But if you look at by income level and by region, they are not much balanced. Especially lower middle income countries, most of their spending is on adaptation, but only few percent, 0.1% is on mitigation. While Latin America, they are also saying that most of their spending is a mitigation, while only 1.5% is on adaptation. So there is imbalance in investment. The breaking down the GCT by technologies. In mitigation, renewable energy, renewable energy, and energy demands are the most of 7 technologies. And here, adaptation, most of them are invested in water, forest land management, and also agriculture. So I'm gonna summary the key findings from the analysis into 5 points. First, green recovery spending of developing countries is still not enough to meet the Paris Agreement recovering from the COVID-19 pandemic crisis. Only 0.26% of GDP and 11.6% of recovery spending. So basically, it's very needed to increase the amount of recovery spending as well as percentage of green spending out of recovery spending. This is the most overarching message from the analysis. And the second point is the high percentage of green recovery spending, more than 50%, is mostly by high-income countries, which can be interpreted that they have more ambition and effort on green investment. And third point, most of green recovery spending, or more than 99%, is composed of technology, which one time echoing the significance of technology in the recovery process, but at the same time, it gives us the demand for other type of recovery spending, such as non-infrastructure, employment training, job creation, those kind of non-infrastructure spending should be added more. And fourth point is the balanced GCT spending between mitigation and adaptation, but there is heavy imbalance if analyzed by income level and region. So there should be the balance between mitigation and adaptation in terms of technology. And fifth finding is that GCT spending scoot towards certain technologies, both in mitigation and adaptation. But this needs another analysis, another level of analysis, whether this is just their low demand for certain technologies, or they have no access or no investment or no finance to certain technologies like hydrogen or CCUS, those kind of high level state-of-the-art technologies. So there should be another analysis for the region of the lack of certain technologies. So I'm going to give you 3 more recommendations shortly before I wrap up my presentation. The first is that government should prioritize green investment. The one good example is the green budgeting of France, that when they make decisions on expenditure of the government, they make the system of tagging, whether this is green, whether this is gray, or whether this is unfavorable expenditure for the environment, so that they can give priority to the expenditure depending on, according to their impact on the environment. The second recommendation is that in the same manner, donor countries should expand green ODA, especially to low-income countries. And also they need to diversify investment in adaptation, including climate change forecast and monitoring, disease control, and also food safety. I'm going to introduce this the case. This is by South Korea, Climate Technology Information System. This is the platform where developing countries write down their demand for the technology, while the global enterprises and global the funding organizations come and share their technologies and their fundings, so that these two parties can make the collaboration in matching their supply and demand. The third last recommendation is that green stimulus should be accompanied by other policy types, not just technology, but non-infrastructure, such as regulatory change, fiscal reforms, and skills training. These are only done by only 6 countries at the moment by the data. So there should be the expansion of investment in non-infrastructure spending. The period after COVID-19 crisis could determine whether the world meets or misses the emissions goals of 2015 Paris Agreement. So we should be so much careful in giving more our efforts to green stimulus, recovery from COVID-19 pandemic. This is the end of my presentation, and thank you very much.
Thank you very much for very interesting and comprehensive presentation. I really hope we can get back to some of the issues and recommendations that you presented. Thanks again. We will move on in the interest of time. I see we need to be a little disciplined here, but our next presenter is Jacob Hensel, who is from greeningfinance.org, and his presentation will be changing the focus a little bit, I believe, to look more at temperature scores and portfolios. A very interesting topic. So over to you, Jacob. Looking forward to an exciting presentation. Thanks so much.
Thank you very much. I may need a minute to start sharing my screen. Apologize for the delay.
No worries, take your time.
It looks like I can try again. Okay.
Yes, we see it.
All right, great. All right, apologize for that. Thank you for the introduction. I'll just jump right into this presentation. The intent is to really explain how these temperature scores can be used, how they can be interpreted and misinterpreted, and then explain to you why I think this all matters. So let's jump into it. So when we're talking about this, it's good to take a step back and just think about what this is trying to solve before we jump into what exactly temperature scores are. So when you're talking about these four groups that I've highlighted, retail investors, institutional investors, fund managers, and then the organizations, the entities that actually emit carbon into the atmosphere, they've all got kind of a common link, and that link is capital. So some have it, some manage it, and of course the organizations, the carbon emitting organizations, need it to sustain and grow their organizations. So so I think there is an opportunity among these groups to kind of create this virtuous cycle where there's more interest on the retail investor and institutional investor side for more carbon efficient organizations. Fund managers want to meet that demand with their products and services, and carbon emitting organizations want to align with investors' values, investor objectives, as well as their customers. So that's a little background. In terms of what's out there, there's a lot. There is a lot. So this can create some problems. It can create issues, of course, greenwashing. I think we're all familiar with that. It can make it hard to kind of align on any one clear path, or really take kind of a coordinated action among those groups, regulators, and so forth. So I think that kind of sets a little bit of the backdrop. So the question is a temperature score the solution to this issue? And I don't think it's the solution. I don't think there is one solution. There are shortcomings to them. There are limitations, but I think they're important enough to discuss and be aware of as we move forward. So in terms of what is it now? So what are temperature scores? So essentially they're a carbon efficiency or a carbon intensity measure, which is just a fancy way of saying, how much emission, how much CO2 emission, say scope 1 and 2, per something else. So for comparability across sectors and firm sizes, the the preference is to use, dollar amounts, and revenue happen in this example is easiest to scale to kind of a global temperature score, which I'll get into next. So carbon efficiency, carbon intensity is emissions per value of goods and services. Example, right, you can see in front of you 2.3 tons of CO2 per, for instance, $1 million US of sales. And then once you have that, the next step is to kind of scale it globally. And then from there, you can get an implied temperature score. So just to kind of conceptually lay it out for you. So you have the carbon intensity of a company or a portfolio, for instance, if that's your perspective. It's scaled to kind of a global expanse using GDP figures. Then you generate kind of cumulative global emissions over a time frame. So for instance, I will do an example with you that goes through the end of the century. And then with those emissions, there's an implied temperature rise score. So I'll talk a little more about that. So in terms of what it means, so the temperature score is essentially what would be the global mean temperature increase at the end of the, in this case, we're going to the end of the century, but in terms of a certain time period, if the entire economy had the same emissions intensity as this company or portfolio. So it's not where the world will be in terms of its temperature in in 80 years or in 30 years from now, but it is kind of a relative indicator of how this asset, how this portfolio performs, given the kind of carbon it's emitting for the relative to the value of goods and services it produces. So, okay, so what does this actually look like? So here's one example of Nestle out of Switzerland. So just to quickly walk you through it, you've got their sales from their financial statements. They have a sustainability report that estimates their scope 1 and 2 CO2 equivalent emissions. From that, you get that intensity or that carbon efficiency score. And then moving down, right in the middle there, you've got global GDP. So this is important to kind of scale it, because conceptually, what you're saying is, if every company on the planet operated at the same carbon intensity as Nestle, what would that look like? There is a scaling factor, that's that theta figure. So you don't capture all the anthropogenic carbon emitters by simply looking at corporations. There's other sources of carbon emissions, so there's this adjustment factor. Finally, you get equivalent CO2 emissions per year, and then you can add those up over time. And then there is an implied kind of temperature range from those emissions. So that's kind of at the heart of it. Here's another example. So looking at a range of corporations. So on the left chart, you have kind of starting at the left side, you get the most efficient, the ones that can emit the lowest for their relative to their sales. And then all the way to the right, you have some very high bars there in blue, and those are the big emitters relative to their revenue. That dashed line, it shows you where you're at for the whole portfolio, so kind of averages across it all. And then on the left graph, you can see temperature score and emissions intensity. So you've got these in green. They're kind of they're the ones that score under 2 degrees Celsius, and you've got on the dashed line, you've got the emissions intensity. So you can see that bottom line, more emissions relative to what the company is producing, the more emissions, the higher the temperature score. So, all right, so, okay, that's a really quick overview, just scratch the surface, but it's worth pointing out just how this could be misinterpreted, just given the fact that we are putting a temperature score on these assets, and given all the discussions about being aligned with a certain temperature globally through the Paris Climate Agreement and other agreements. So what does it not mean? And what it definitely does not mean is this is the actual global temperature outcome. I think that's pretty clear to everybody, but just want to emphasize that. These are really relative performance. This is a really relative performance of companies or an investment portfolio. It's not actual global temperature outcome. This isn't the only thing that matters. That's kind of obvious to say, but there are, for instance, the financial taxonomy from the EU lists 6 environmental objectives. One is climate change mitigation, and you could argue that a temperature score falls into that bin. But then there's also climate change adaptation, which this would not give you any information about. The protection of water and marine resources, again, not covering that. Transition to a circular economy, really not a clear indication of that, and so forth. In terms of investing or divesting, so when people talk about temperature scores or other ways to encourage investment one way or the other, it's not always clear that that's actually going to cause emissions to fall, which is what really matters at the end of the day. So investment based on a temperature score, at least at the margins, doesn't really, I think, have a material impact on emissions. But I think engagement or disengagement that is informed by a temperature score may have that kind of positive impact, and especially a coordinated, more widespread response involving investment or divestment. A couple more, a portfolio or a company with a low temperature score. So if you looked at that example with Nestle, if you recall, that was what? It was about 1.8 degrees centigrade for temperature score. That doesn't mean that Nestle only produces products or services that, for instance, are compatible with the goals of the Paris Climate Agreement. They may have products that are high emitting relative to the revenue that relative to their efficiency, for instance. The same with the portfolio. So you looked at the example of portfolio. There's a lot that are on the efficient end down there in green, but you also see some outliers that are really high. So a portfolio kind of smooths out those differences, and you can have assets in there that really are not compatible with, for instance, your environmental objectives. And last, a low temperature score means little or no transition risk. So transition risk is a big topic, especially TCFD emphasizes that. It's likely that there's less transition risk with a lower temperature score, but that cannot be assumed, and those companies could still face those types of risks. All right, wrapping up here. So why I think this matters, why I think it's worth our time to at least briefly have an overview and talk about here. First of all, it's familiarity. So that comes down to, it's degrees. So it's very clearly kind of and logically, at least in people's minds, connected to climate change. And that's one of the strengths of it, but that's also one of the potential, pitfalls or misinterpretation. It's fairly easy to do. I was able to do it within a few hours of reading about the methodology. It's something that you can quickly kind of, I think, scale up. So I think that has I think that's more likely why we're going to see it in the future. Benchmark. So benchmarking is really important when deciding whether the investment is meeting the objective, whatever your investment objectives are. And so having a number immediately makes it much easier to benchmark than say some more subjective scoring of environmental, social, or governance outcomes. And then for the same reason, monitoring. So you can monitor how you're performing, your company or your portfolio is performing over time, having this benchmarking and ease of monitoring. There is, more and more talk about kind of regulatory compliance requirements, more interest in ESG in general. And so there's always going to be, I think, a bias towards kind of a simpler way to quickly make decisions that meet environmental investment objectives. So I think this has a heads up there on some of the other ways. And lastly, why it matters is, if it is out there, there is that potential for misinterpretation or misapplication that we went over. And that covers it all. I provided a list of references. If anyone would like to read more, I understand these are going to be shared after the event. So with that, I will yield the floor.
Thank you very much, Jacob. Very interesting presentation, and thanks for sticking to the timeline. Much appreciated. So the final presentation will be by Soo-Hyun Lee, who is with the Seoul National University of Asia Center, and he will talk about creating a UN framework that could facilitate, or I think could create maybe just a framework, let's call it that, around sustainable investments. So thank you very much for participating in this, Soo-Hyun Lee, and the floor is yours.
So thank you for that introduction. So unlike the other experts here today, my expertise is not primarily in sustainable finance, but rather investment law as an international lawyer. So I'll have to ask for your forgiveness for my ignorance beforehand. So the work I present today is the result of a little more than a year research stay that spans Seoul and Tokyo in search for the legal implications of sustainable investment as a methodology before I return to Sweden, where I am based. So the overall project I'm presenting today, what I'm presenting today is part of a larger project that is largely composed of two parts. The first part is identifying a unified and multilateral position of what the role of international investment in advancing sustainable development, and it's based primarily on the multilateral legal instruments and the substantive materials of the United Nations, so policy and substantive positions. The first segment looks at foreign direct investment, FDI, and the second looks at FPI. And so my presentation is about the latter, about foreign portfolio investment and its role in sustainable development. And the objective of this part of the project was to develop a legal notion or a substantive notion of sustainable investment based on 20 to 30 years of policy and substantive engagement by the UN on this issue. And the second segment of the project is, of course, to shape a legal interpretation for use in international investment law. So that's in the shaping of investment agreements and the interpretation in investment disputes. So I think I'm really lucky to have gone after the previous speaker who spoke a lot on the technicalities of sustainable investment and its measurements. So building on that, the question then becomes, well, how does one go about formulating a notion of sustainable investment? And so a broad overview of the literature and of both financial and legal practice shows that a notion of sustainable investment must at least include two platforms, at least in order to answer the question that's asked by the project overall, which is how does international investment contribute to sustainable development? So the first platform is that the notion must provide a system of indicators and metrics that ultimately understand how investment contributes to sustainable development. So that system must be self-enclosed, which means it must account for input gaps such as lacking data. And there must be significant surrender to lack of data. So how does that lack of data tabulate in a self-enclosed system? So these indicators essentially set the parameters of the system, and the metrics that define the values essentially populate those parameters. So broadly put, the indicators would essentially provide the definition of sustainable development being used in the system, and then we turn back to the larger project, which we then try to find a legal interpretation. So a more granular system, for example, would include a more extensive or expansive and diverse set of indicators. So for example, a system that would include that looks primarily at environment, such as a temperature score, versus, let's say, a different metric system that would look at the environmental and the social aspects. So any such system would have to have enough metrics that could fill the technical criteria to sufficiently describe what is in the environmental dimension or the social dimension of sustainable development. The second platform needed in this notion is that there must be a set of standards that dictate how the indicators and the metrics are monitored, reviewed, and verified. So MRV is an important aspect of the UN process. And this process of systematically reviewing the tenability of indicators and metrics and then verifying the performance behind those metrics is an important safeguard, essentially. And the safeguard ensures that it protects against greenwashing, as well as it provides member states on a multilateral basis to be able to verify the type of investments that would contribute to their economy and their sustainable development in good faith. So for example, if you deconstruct a ESG rating system, which is a notion of sustainable investment, we can find that it's essentially made up of three core components: scope, KPIs, key performance indicators, and metrics and data. So the scope essentially defines the operative, provides an operative definition of each pillar of ESG, which is then populated by key performance indicators or KPIs, and the KPIs essentially define the issues of each pillar of ESG and defining materiality. And the metrics and the constituent data then provide the numerical measurement of the KPIs based on different levels of calculation. So as we know, and as the previous speaker had mentioned, there is considerable controversy and limitation surrounding each of these components of any notion of sustainable investment, especially ESG ratings. And the problem then becomes that, well, there's multiple ESG ratings, but even though they have the same core components, the problem is that the rating rendered as a result of that calculation is extremely different. And so the question then becomes, what causes that divergence? So the cause of divergence can be identified essentially into falling into two categories. The first is whether it's methodological, which is essentially how does the method aggregate and then weight the calculation of the score. And the second category of difference is value-based. So that's the way that the system might define what sustainability is. or it might take into consideration differences in country context and geographical idiosyncrasies. So for example, in the previous presentation, one part of the definition of a temperature score was not to include other dimensions of sustainable development, and thus increase the granularity and the accuracy of that score. So even though there's been very unsuccessful attempts at harmonization across these ESG rating systems or any notion of sustainable investment, that's not to say that there's not been very rigorous attempts to do so. So the most commonly observed approach at harmonization has been self-governance. And these are largely led by private sector-led coalitions that are subscription-based. And the most successful, as we all know, are the Global Reporting Initiative, the GRI, the Sustainability Accounting Standards Board, the Task Force on Climate-Related Financial Disclosures, TCFD. And the similarity between all these coalitions is that it's predicated essentially on the willingness of each of its members to self-govern. And that is essentially the primary limitation of these models. And again, returning to the larger project, the limitations of their legal merit. So yet, despite these attempts at harmonization and self-governance, ultimately, the research finds that the ultimate limitation of these models is that there's a limitation to access to data points and collection methods. And this is because many rating agencies carefully guard the confidentiality of their systems and their methodologies for business purposes. And that becomes a problem because you have the same company over the same period of time receiving entirely different ratings, which is sometimes a very large gap, which is quite befuddling if you think about it. So finally, another limitation of the self-governance model is that there are wide differences in the way that transitioning states and companies are encountered, right? So at the macro level, this could be how companies companies from or investments located in developing countries or low-income economies, which may be limited to their capacities to achieve the same results as another company or another investment in a high-income country for such reasons as a lack of digital infrastructure, for example. So another aspect that's missing from a lot of these sustainable investment notions is that at the micro level, there's some difficulty in levelizing the differences between sectors and firms. So there are, as we all know, there are firms and sectors that are either entirely excluded from or inherently disadvantaged in sustainable investment. So for instance, tobacco and weapons companies are regularly considered stranded assets, and that precludes them from joining or meaningfully engaging in a lot of these coalitions. So while the success in harmonization has been quite limited, there has been some promising signs of convergence that we've been able to identify. So for instance, the research shows that indicators that are aligned to SASB tend to be about 70% aligned with the UN Sustainable Development Country Indicators, meaning that they bear considerable relevance, at least to some level of confidence, to larger multilateral frameworks like the Sustainable Development Goals. So another promising sign of convergence is that there is a greater ubiquity of the so-called science-based indicators. And this oftentimes draws on expertise and conclusions made in the reports by the Intergovernmental Panel on Climate Change. There is promising signs of convergence, but we have not been able to see any successful attempt at harmonization. So now we're ready to begin constructing this notion of sustainable investment. So at the core of any notion of sustainable investment, so it's the definition of what is fiduciary duty, and that essentially guides how to manage and then assess the performance of an investment. The UN, I found what the UN identifies or defines modern fiduciary duty as considering all financially material factors, as well as emphasizing the importance of what they call positive duties on investors to incorporate sustainability issues. So in practice, this is can be interpreted in three ways, at least legally again. So number one, sustainable development factors must be incorporated in investment decision-making abilities, making decisions, because they are financially material, even though they may not arise from a financial source or a financial cause. So the second interpretation is that investments must take into consideration the changing nature of sustainable development, meaning that the time frame becomes different and can transform over time. And the third interpretation is that investors should actively understand and incorporate sustainability issues in managing assets, which is this positive duty aspect of the definition. So for example, sustainability themed funds, which we saw rapid growth of during the pandemic, use ESG criteria in the security selection process, as well as in the measuring the positive impact of the fund over time. And so this is a rudimentary example of how what might embody this modern fiduciary duty. So the first component of the notion of sustainable investment that I've created was is scope. And the scope is a notion. So scope can essentially be divided into two core elements. The first that's identified quite frequently throughout the United Nations is net positive impact, and the second is catalyst effect. So the first of these, net positive impact, is crucial and really quite universal across the UN system. And what it means is that it refers not only to extra financial value, so this abnormal profit added from the rate of return, but also accounts for negative impacts of the investment as well, or outcome risks. So an investment that results in a positive environmental impact while being profitable, but at the same time resulting in considerable social consequences would not qualify under this net positive impact criterion. So the idea of net positive impact is perhaps best captured by the Sustainable Development Investment Concept, SDI concept, which is proposed by the GISD. And the SDI essentially proposes a way to measure net positive balance between SDG aligned contributions to SDG unaligned consequences. And what's interesting about the SDI interpretation is that there's two agents in the analysis. It's the private sector investor and the investment itself. So the reason why that's interesting is because the agent, the actor, the investor, the company, may have kind of embody all the many aspects of sustainability, but that does not necessarily that any investment that they make can qualify as a sustainable investment. And the second agent, of course, is the investment itself. So what's interesting about the STI definition is that an investment can qualify as a sustainable investment in the UN framework, but even though the company, the investor himself or themselves, does not necessarily qualify under the rubric of a sustainable investor, for example. And adding to that, of course, is there's multiple of them, but for the interest of time, I just reduced it to these two. Another one is a finance taxonomy and the impact centers by the UNDP. And the UNDP adds a second level of net positive impact, which is leave no one behind. And that, of course, is identifies who is affected by what. So the second core element of the scope is the catalyst effect. And sorry, I'm just checking the chat. The second core element of the scope is the catalyst effect. And this is essentially how do shareholders and investors in investments serve as catalysts towards causing or resulting in sustainable development. And that essentially is through engagement. So investors or asset holders will then use their stewardship rights or their voting abilities to influence corporate behavior and decision-making for invested companies. So I'm trying to go fast because I'm running out of time. So in practice, what this would mean is, as the two presenters before I identified, it can be in technology and energy. It can also be in motivating companies to then take more ambitious action in kind of multilateral activities. So for example, the Net Zero Asset Owner Alliance, which is a project of the UNFFI, UN Environmental Program, it employs what are called capital allocation strategies. And so what they'll do is they'll leverage the weight of their investments towards companies with greater carbon efficiency. And that would essentially reward companies for enhancing their sustainability performance. The third and final interpretation of the catalyst effect we found was policy advocacy and active ownership. So policy advocacy is when investors, so we see this a lot with, for example, BlackRock, institutional investors or coalitions of investors will put the weight of their financial leverage in order to affect policy. The second component of the notion are KPIs. And when it comes to KPIs, the UN doesn't have a particular position on expanding, this very, very expansive universe of KPIs. Instead, the UN's approach has generally tend to be more closely aligning existing KPIs to multilateral development agreements, such as the 2030 Agenda. However, the UN does identify that there are two primary interfaces on how to increase alignment between the KPIs and, for example, the SDGs. And the first is real-world impact. And real-world impact broadly means that KPIs should be able to be measured quantitatively and should be based on science. And so one example of this was the business ambition for 1.5 degrees centigrade Celsius by the UN Global Compact. And another aspect of this real-world impact is that metrics or KPIs should not be static, in the sense that they should be progressively and upscaling the ambition of climate change mitigation adaptation impact. So for example, an investee company should increase the factor in scope 3 emissions over time, over X number of years, and that would be an example of a forward-looking interface. The second approach to KPIs has been what's called additionality or universality. And this is essentially expanding the number of participants in sustainable investment. And this has been emphasized quite a lot in the UN, and that includes, for example, one of the most perhaps prominent examples is the UN Sustainable Stock Exchange, SSE, which tries to mobilize national actors to participate in sustainable investment as a condition to listing publicly in that respective country. So very quickly, the last component of the notion is metrics. And the UN generally takes what's called an aggregative approach to metrics, which is that it tries to find a cocktail of metrics and data that is the best able to reflect the diversity of the Sustainable Development Goals while not being so esoteric as to cause barriers to entry. However, I'm running out of time, but more than data, the UN is more interested in weighting. And weighting, of course, is a way to levelize or normalize differences in characteristics. So for example, the UN is largely motivated by trying to get more people to join sustainable investment. And so by levelizing or creating weighting or normalizing procedures, it allows for smaller companies and companies from developing countries to engage more meaningfully in sustainable investment. I'll skip this. So at the end of the research, this particular aspect asks a few questions in terms of, well, we have all these sophisticated systems, but does sustainable investment contribute to sustainable development? And there are 4 questions that essentially need to be answered before we can reach that conclusion, especially legally. Number 1, does it address country-specific, country-contextual development concerns or just broad development concerns? Second, does it cause or create conflict, or does it cause more greater cooperation between national stakeholders in the host state? Third, does it promote a level playing field, not only within the country, but with key economic partners? Does it, for example, violate WTO agreements? And fourth, does it result in a more harmonized rule-based system? So to answer these questions, of course, it's constantly debated and we have to see over time. But essentially the UN and the notion that this is trying to create is at the center of a debate, which is, should we continue with a self-regulation model, or should it be a more top-down centrifugal model where a government will identify the minimum requirements for sustainable investment, define sustainable investment and what it is? And ultimately, the point of the notion and the point of trying to create legal interpretation of the notion of sustainable investment is that by sticking closer to multilateral consensus through the UN, we can find that there's more consistency and more predictability, not only in sustainable investment, but also in the legal system surrounding it. And so that, thank you for your time.
Thank you, Soo-Hyun Lee. Very interesting. Lots of issues to discuss. Unfortunately, we don't have a lot of time, but you really covered a lot of stuff there. Much interesting stuff there. So, we have to be short when now we go into and to the point when we go into the Q&A section. But I really would like that we just have some discussion. So I'm going to start with Janata and Michael. If they could expand a bit on how can we mobilize more private finance or more commercial investments in the Asia region in particular, and what are some of the challenges? And you might want to illustrate the challenges by maybe picking or contrasting two countries and tell us what you see are the barriers or the bottlenecks in mobilizing climate finance from the private sector. Over to you.
It's a good question. I think it's a bit of a multivariable problem, which we probably didn't get to as much as we would have liked in our presentation. But I think it all starts with something very simple, and that is setting net zero targets, which still haven't been forthcoming across ASEAN, across all of ASEAN, should I say. And from there, because it becomes a snowballing process, once you set that net zero target, you can build your long-term strategy. Once you can build your long-term strategy, you can develop cross-ministerial coordination between your long-term strategy, financing institutions, etc. And that's when you start to get that or gain that comprehensive architecture for being able to implement mandatory disclosure standards and some of the other things we were talking about. Especially a power development plan, all of a sudden, if you have a long-term strategy, has more coherence in terms of the extent to which you can work and expand that demand side integration, build up your procurement and contracting mechanisms, etc. So I think it all starts from that simple commitment and flows to there. And I think what Southeast Asia probably hasn't done well enough in the last 5 years relative to other parts of Asia is actually be able to set that target, set those long-term strategies. But I think the second part to that is also working together as a region more closely. Janata could probably speak to it better, but once you have those domestic building blocks in place and you've improved some of the disclosure standards, I mean, there will be push and pull factors. For example, like coal financing is on the way down. We know that now. Japan, China, and Korea, who in the Republic of Korea, who together finance a lot of ASEAN's coal. They've announced intentions to divest from that. So, there will be factors that drag ASEAN towards it as well. But I think at a regional level, things like, and maybe Ege can talk to this, the APEC and common priorities that are pushed through regional pipelines will really help to mobilize private financing. So once you have that domestic architecture in place, you can feed up those policy priorities. And APEC represents the first step of that, where they're targeting, cross-border integration of power supplies in order for the comparative advantages, of solar, wind between different countries within ASEAN to share that. And that once you can build a project pipeline at that regional level, you can then start to de-risk and get more significant interest than an individual ASEAN member state might be able to get from a financing perspective. We know that blended financing instruments are not perfect at the moment. They're touted as a big thing, but they actually, for lower income countries and middle income countries, they have a constrained ability to actually crowd in the private financing that their promise suggests they could. But we like to think that, if more comprehensive regional action was taken around 2 to 3 priorities, renewable energy being one, probably nature-based solutions and blue carbon being another, or another 2, especially around peatlands and peatland conservation, then you could start to actually scale funding by building these cross-border mitigation projects. But maybe I'll hand over to Janata to finish that off if there's anything I missed on APEC and some of the work being done there.
Thank you, Michael. Janata, any final comments?
No, I think it's already well said by Michael, but I will add some of the key identification from our latest projects with ASEAN Center for Energy, for instance. So given the many climate finance fund or platform already established, but our respondents in the 10 AMS say that a regional climate fund also needed in terms of to gather and mobilize some necessary fundings to the regions. And maybe that's another addition from me. Thank you.
Thank you very much. If I can continue with the Green Technology Center with Hannah and Min-Cheol, can you give us some examples of transformational technologies and how you think that they can help us get to where we want in terms of having the technologies that we need to address these rise in emissions? And I was wondering in particular, but you don't need to dwell on it, green hydrogen, which I know is an important issue in Korea, but also increasingly in other countries. And it's also something that GGGI is looking at, obviously.
Thank you for the question. I'll see we're lacking out of time. Just give short answer to it.
We have been allocated a little bit more time, just so you know. I've successfully requested some more time.
So technological innovation is based on the theory called systems transition by the people from Netherlands, and they think that the regime technologies such as fossil fuel-based technologies, they should be changed. They should be transformed towards green technologies such as renewable energy and non-renewable energy, and also many the technology like CCUS, those kind of the non-emission energy sources, using those kind of energy sources. So the one example I like to raise here is the Korean government just recently released the net zero scenario for 2050. And here includes the CCUS technology. And also, in addition to it, we have put these 100% shift from the coal to hydrogen in making direct reduced iron. So by 2050, we have made the scenarios to gradually switching from coals to hydrogen as a resource to produce the iron in steel-making industry. So this kind of the shift of the technology from coal-based to hydrogen-based, this is the one main technological innovation which will help reducing the emissions from the industry sector. Yep.
Thank you very much. And let me see here. Yeah, I'm not on. Yeah, I'm on mute. So thanks so much for that. And Jacob, if I can go to you, and very interesting things that you presented today. So I guess the key question is, do temperature scores actually make a difference, and can they help encourage decarbonization or reducing emissions and get to least emissions? What is your view on that?
It's a tough question. I think it comes down to the degree of adaptation. So I think with the limited number of investors, for instance, prioritizing this type of investment, then there's always another investor who can just swoop in and provide that needed capital, for instance. So at the margin, I don't think there's a lot of real world impact, but I think it's easy to argue that after a certain threshold is met, I don't know what that threshold is, but I can speculate. I think after a certain threshold is met, then you start to, like the early adapters, bring more adapters on. There starts to be kind of positive feedbacks where now more capital is being directed towards activities that are more compatible with the goals of the Paris Climate Agreement. And so other people want to be there, those who need the capital want to be there lined up for it. Just speculating here, but I do recall a study about early adopters. I think the context was workplace and other adaptation. And they said the threshold was actually around 15%, which, if that is the case with, the investment community, then I'm would be more optimistic, because 15%, if those early adopters then mean that those on the sideline, the majority that's kind of silent, jump in and kind of follow that lead, then you very quickly have something, a very positive kind of feedback cycle. So, yeah, that's where I'll leave that.
Well, thanks very much. Food for thought. I think it's interesting, and I like the emphasis of simplification. But as we know, this is an area that has challenges in terms of simplifying things. But particularly, probably private investors want things to be, not too difficult to wrap their heads around. That's what we understand in terms of in the sector, in the green bonds space. I think there's still really a need for standardization of green and what are you buying, and it seems to keep investors on the fence. But that's maybe for another day. I would just like to move on to Soo-Hyun Lee. Again, a fascinating presentation, obviously a little bit different and fortunately so than what we discussed in the previous, or in the earlier part of the panel. But I was wondering, if we want to turn this idea into practice, how could it be implemented, this UN framework you're talking about? And I was wondering who would be the key organizations apart from UN organizations themselves. As you were speaking, that these were issues I was pondering, and also depending on, well, if you look at the UN system, it also involves some of the MDBs, the multilateral banks. So how and who could help implementing this framework? That's my question.
Yes, thank you for that question. And so the notion, as well as the larger framework, is supposed to be designed again for legal implementation. So in terms of the who and how, I guess if you look at the ex ante, then it'll essentially be trade negotiators, investment negotiators, and they'd have to be integrated at the level of investment agreements, trade agreements, free trade agreements. And we see that there's a large population of increasing population of these agreements, and you can easily spot them if they include words like comprehensive or progressive. So the CPTPP, for instance, has a very extensive chapter on helping to identify understand more carefully what is the more peculiarities of sustainable investment or sustainable development. And so in terms of implementation of the notion or the framework that I hope to do, and also some of my work at the UNDP is also around this implementation, is that if there's a question of let's say two companies operating in a foreign a host state. So two foreign companies operating a host state, and they both claim that their investment is contributing to the host state's sustainable development. It would require first the national jurisprudential structure, national court, to then interpret, well, what is sustainable investment? But of course, this will be limited in their application of legal principles based on their constitution or whatever else. And then it might progress into a higher instance of court, such as the International Center for Investment Disputes, right? Or any permanent arbitral tribunal, where they would have to and then look at multilaterally, what are some of the key agreements and consensus around what is the idea or notion of sustainable investment that they can use to administer a ruling on who was perhaps correct in this situation of conflicting claims. So if it was it company A that was actually engaged in sustainable investment, was it company B, or was it neither of them? Was it the state that provided false interpretations? Or so essentially to culpability issues, I hope that this kind of system would find some application.
Thank you very much for that answer. Very succinct and also very ambitious idea. Obviously, but we need to be ambitious. Thanks very much for that. So we are at the end of this event. I think we have had a really interesting discussion. Not enough time, obviously, but I think at least we put some interesting ideas on the table. We had also invited a participant from Indonesia who could have brought, let's say, more the view of a developing country, who unfortunately couldn't make it, but I think we still managed to have a pretty good discussion. So with that, I just want to thank you very much and being part of kicking off GGGI week. Your contributions are much appreciated, and we hope to stay in touch. Thanks everybody, and thanks for internet that were working pretty okay. Certainly from my side, I understood there had been issues in Seoul or even in Korea, but that didn't get in the way of this event. So thanks again, everybody, and hope to stay in touch. Bye-bye.
Thank you. Bye.
Bye.
Thank you, everyone. Bye.
Bye.
All the best.